For some time now, we've been watching where the global financial system is heading. And honestly, what's coming next is not just another bad year. 2026 could be brutal. Not because of a normal recession, not because of a bank run, but because of something much bigger. Let me explain. In a simple way, the real problem starts in the bond market. Most people don't watch bonds. They watch stocks, crypto, real estate. But the bond market is the plumbing of the financial system. And right now, that plumbing is starting to shake. Bond volatility is waking up. The MOVE index, which measures stress in the bond market, is quietly moving higher. And historically, that never happens for no reason. Bonds don't move on hype. They don't care about stories. They move when money gets tight. And that's exactly what's starting to happen. Three pressure points are lining up at the same time. This is what makes the situation dangerous. Not one problem, but three big ones hitting together. The United States. In 2026, the US has to refinance and issue a massive amount of debt. At the same time, deficits are huge. Interest costs are exploding. Foreign buyers are pulling back. Dealers have less balance sheet than ever, and we're already seeing stress in long-term Treasury auctions. Weaker demand. Bigger auction tails. This isn't a theory. It's already visible in the data. And this is how funding shocks begin. Not with panic, but with auctions that quietly fail to attract enough buyers. China. Behind the scenes, China still has a massive local government debt problem. If stress there turns into a visible credit event, the yuan weakens. Capital looks for safety. The dollar strengthens. And once again, that feeds directly into higher US yields. Japan is the largest foreign holder of US Treasuries. It's also the backbone of global carry trades. If the yen keeps weakening, the Bank of Japan is forced to react. Carry trades unwind fast. And when that happens, Japanese institutions sell foreign bonds too. That puts even more pressure on US yields right when the US needs demand the most. Japan doesn't cause the shock. It amplifies it. The trigger doesn't need to be dramatic. This is the scary part. The trigger could be simple. One badly received 10-year or 30-year Treasury auction. That's it. One bad auction is enough to spike yields, tighten global funding, and force risk assets to reprice fast. We've seen this before. In 2022, the UK gilt crisis followed this exact path. The difference now? Scale. This time, it's global. What happens next? If this kind of funding shock hits, the sequence is predictable. Long-term yields jump. The dollar strengthens. Liquidity dries up. Stocks fall hard. Crypto sells off. Volatility spreads everywhere. This isn't a solvency crisis. It's a plumbing problem, and plumbing problems move fast. Then comes the response. Central banks step in. Liquidity is injected. Swap lines open. The system stabilizes. But at a cost. Another wave of liquidity. Phase 2 begins. Real yields fall. Hard assets catch a bid. Gold moves higher. Silver follows. Bitcoin recovers. Eventually, the dollar rolls over. The shock clears the path for the next inflationary cycle. Why 2026 really matters. Not because everything collapses forever, but because multiple stress cycles are peaking at the same time. The world can survive recessions. What it struggles with is a disorderly treasury market. That risk is building quietly beneath the surface. And it's worth paying attention to, long before everyone else does. The world is changing fast. Don't get left behind. See you in the next one.